Hey guys, welcome back to the show. Today we're going to talk about the 10% credit card rate cap debate and why it's missing a real point. There's a new proposal getting a lot of attention. Trump is talking about a one-year cap of 10% on credit card interest rates. The major banks are pushing back. JP Morgan, Bank of America, Citi, and others have all said some version of the same thing. They argue a cap would reduce access to credit, especially for subprime borrowers. They said approvals would tighten, limits would shrink, and some people would get cut off entirely. See, on the surface, that sounds reasonable, and parts of it are. See, credit cards are unsecured loans. Risk is real, and if lenders can't price for risk, they ration credit. That's not a theory, that's how markets actually work. So yes, under a hard 10% cap, some borrowers would likely see fewer approvals or lower limits. That could affect utilization scores and even credit scores. But here's where the conversation usually stops too early. There's a contradiction people feel but don't always articulate. See, banks say a 10% cap is too risky because some borrowers may default, but they're comfortable lending to the same borrowers at 25 to 30% annual interest. That's not about borrower safety, that's about pricing risk, not reducing it. See, higher interest rates don't make risky borrowers safer. They make borrowers who do pay far more profitable. And that doesn't make banks irrational, and it doesn't mean a cap rate is automatically the right answer. It does mean the opposition isn't primarily about consumer protection, it's about protecting a business model. And credit card lending is a very profitable business. So the question isn't whether a 10% cap rate sounds good or bad. The real question is what problems we're trying to solve. If the goal is to help people trapped in revolving balances around 25 to 30%, a cap sounds appealing, but price controls don't eliminate risk, they move it. The costs show up somewhere else: tighter approvals, lower limits, new fees, reduced rewards. A borrower's push towards worse alternative. There's also the timing issue. A one-year cap doesn't change behavior permanently. It can encourage balance buildups followed by snapback when rates normalize. That can make things worse for people already stretched. So my takeaway is simple. Don't react to the headline. Look at the incentives and the second-order effects. And if you carry a balance today, waiting on politics isn't a strategy. The interest meter is running regardless. Remember guys, this is general education, not personalized advice. Everyone's situation is different.